In our continuation of our series, Economics 101, we now discuss the producer price index. We're going to show you how this differs from the consumer price index and one particular quite disturbing trend which has emerged only this month. The producer price index, otherwise known as the PPI, reported on a monthly basis from the Bureau of Labor Statistics. It represents the cost of goods and services charged by the producer. When it indicates rising producer costs, those costs are typically passed on to the consumer. It's important to remember this is the cost of raw materials and those products produced that are then sent to the retailers and ultimately the consumers. This month, the PPI on a month-over-month basis up 0.4%. That's the sharpest increase since June of this year. On a year-over-year basis, again, the year-over-year basis shows us more of a trend. We're up 3.0%. That matches levels we haven't seen again since June, but really going back to late 22, early 23, that's the last time we saw such a sharp increase in producer prices. That's not a good thing. That means the costs to the retailers are increasing. Now, we can also discuss core PPI. That is the cost of raw materials excluding food and energy, which are, again, the more volatile components of the inflation report. And we can see core PPI on a year-over-year basis, that's 3.5%. Now, this officially is at levels we have not seen since late 22, early 23. And that certainly is not good. Just as we discussed in a prior report with the consumer price index, weak oil prices have suppressed inflation to some extent. But when you take out the oil prices, fuel prices, we really see inflation is not going away. Now, PPI is greater than core PPI, again, due to weak energy prices. In blue, that's core PPI. In red, that's a standard measure. Again, the standard measure includes fuel, which we can see the core PPI is rising where the PPI is not. Now, this is a disturbing trend. Producer price index is greater than consumer price index. It shows us a potential future inflation that's coming down the road that we may not even see yet. And it can result in corporate profits that are being squeezed. And think about it, the raw materials and those goods that the retailers purchase that in turn are sold to the consumer, those goods are becoming more expensive. The consumer can't afford more expensive goods and services. So who's to suffer? The corporations in the center. And this also can be the result of supply chain issues. We have seen strikes. I don't know how much the strikes we saw a couple months ago have attributed to this, but nevertheless, this is the trend. So in blue, that's consumer price index. In red, producer price index, both on a year-over-year basis. And notice PPI, 3.0%. Versus 2.7% CPI. How significant is this? Well, this is the first time we've seen this emerge since November of 2022. So we're talking 2 years where consumer prices were higher than the producer prices. That's not the case anymore. Will that translate into higher consumer prices? Most likely, yes. I mean, obviously, depending on the sector, but certainly there are higher prices coming down the road. Keep this in mind as the Federal Reserve is ready to cut interest rates again. Do you think it's appropriate that they cut rates in light of this? As a reminder, this is part of our overall series, Economics 101, where we discuss several different of the most significant economic numbers. Last time we talked about the consumer price index. We hope this has been helpful. We look forward to seeing you back soon.